Andrew, thank you so much for joining me today.
Thanks, Lily, for having me.
I wanted to talk to you about on the outlook for 2026. Can you tell me about the macroeconomic outlook and risks that you're tracking?
Yeah, no, that's a fair question. So I think I'll simplify it a little bit. So let's just keep it to the top three. The first that we're looking at is sort of inflation and growth trends, which really pertain to the Fed and a potential, higher for longer type environment. Obviously, there's a lot of, influence and pressure right now from the administration to potentially, see that the Fed lowers rates on a sort of smoother schedule, let's call it, over the next few years. But it seems like there's going to be fewer rate cuts than initially expected. That obviously has implications for discount rates, durations a little bit longer, and then even spread volatility can kind of come into play. And then on the growth side, we're obviously a bit concerned about inflation. That's obviously a big driver behind the Fed holding rates higher for longer. So we're really focused on services inflation and wage growth right now and seeing how that sort of plays into credit fundamentals. I'd say the next risk that we're focused on would be, it's a little bit more sectoral. So it's your more leveraged credits that are running a little hot right now compared to peers, as well as certain cyclical credits as well, and seeing how they're going to essentially, potentially refinance some of their maturities that are coming due. There's a few big maturity walls in certain sectors in 2026 and first half of 2027. Some of these companies have been quite reliant on floating rate solutions now for quite a few years. And with the potential for, again, higher for longer rates, spreads widening out, it's, again, going to impact their fundamentals. It could also result in, kind of, let's say, less spread compression for us on the investor side going forward, some of which we initially underwrote and sort of hoped for. So we'll see on that. And then lastly, I would say the major risk that we're focused on is a liquidity risk. And that's really sort of due to, again, geopolitical influences, policy influences. From a liquidity standpoint, it tends to be the shocks that could really catch investors off guard more than anything. The market just abruptly closes on you for a period of time, public or private market potentially, or the bank's balance sheets get more constrained and there's just less funding available. And so that's how we've seen some adverse results play out here over the last couple of years. I think a few companies learned their lessons primarily during COVID when that happened. But even last year, during sort of Liberation Day, there was kind of that month of trepidation post-fact. So I think those sorts of tail events are very real, and we're going to have to watch them closely and factor them into our analysis going forward.
Yeah, and sometimes you never know where these risks might come from. And with investment grade private placements, they tend to kind of have that reputation that they're hard to trade. What happens when these risks are realized?
Yeah, so I wouldn't say necessarily that private placements are untradeable. I think that's sort of a misnomer of sorts. Obviously, many folks are aware of the historical illiquidity premium that we're compensated with because they're unregistered securities. That being said, I do believe that there's really two primary levers that most investors can pull on in order to sort of generate liquidity for themselves. The first one starts with portfolio construction and pre-positioning of the portfolio. So maybe you have a liquidity sleeve that's composed of treasuries, agency bonds, highly liquid IG, public credit, and that's sort of a means to generate liquidity for you in an event of distress. Barbelling that portfolio as well with your maturities. So it could be including amortizers in the portfolio. It could be some shorter walls versus longer walls. Again, just generating consistent liquidity in the form of principal redemptions is a great means to do it. And then lastly with that, I think security selection and understanding and making sure that the credits that you're putting in that portfolio, if you are truly worried about liquidity, is sort of making sure that they appeal to a broad base of investors. So insurance companies, pension funds, traditional asset managers, the narrower that buyer base gets, the more liquid the security is, and the more challenging it's going to be to sell if you needed to in an event of distress. And then the second lever, I think, obvious for most folks is just our secondary trading market. Last year, just in conversation with a few different folks, I think volume was around 6 billion, so quite healthy. It tends to be a market that has too few sellers and too many buyers. Trades happen quite quickly. But again, those are in the best of times from a macroeconomic perspective. Last year was quite benign, but we saw anecdotally a portfolio, I think it was worth roughly 150 million, maybe 20-ish credits sold in 5 days to well over 10 buyers. And I mean, we took a deep dive ourselves and looked at what was available there. I believe most IG credits, even from what I've heard from the secondary brokers, tend to sell within 3 months. But again, that gets back to the certain factors that obviously constitute that credit. So what's the tenor? What's the currency? What's the rating? All of those things play into really selection for the potential buyer. And you have to go in underwriting to that from the get-go and understanding, what you're getting into from a liquidity standpoint.
All right. So is that liquidity management why issuers would be willing to pay additional spread?
Yeah, so we were talking about this, I think, before we even started the interview. An illiquidity premium is sort of an oversimplification, I think, from our perspective. We do sort of a spread buildup method where we're layering on incremental spread really back from, obviously our expected premia to public comps, which a lot of folks would sort of say in and of itself is sort of just the illiquidity premium you're being compensated for, as private placement securities are unregistered. But what we've seen is it's much more multifaceted. So I think a few of the other forms of spread that we're looking to in our buildup analysis include things like customization of the security. So an amortizing structure that's not all that common. It might be a little bit unique to this issuer. Off the run maturities. So do you want to issue a 4-year wall versus a 5-year wall, which is much more familiar to folks? That's a dominant obviously maturity in the public sector that's benchmark eligible. I think probably after that, confidentiality is another big one for certain issuers. Less disclosure, less headline risk is key. We've definitely seen that out of the sports side a lot as of late. That sector tends to really value that. Complexity premia as well for certain sectors. And that's almost, you could think of it as an underwriting fee of sorts. So esoteric ABS is definitely a sector right now in our market that's getting a lot of talk and discussion. P3s is another legacy sector out of infrastructure. You're absolutely being paid for the complexity and really some of the structuring advice that issuers ask of investors to collaborate with them on those sectors. And then probably the last one I'll call out that's been really popular the last 16 months that I don't think everyone necessarily thinks about the same way, which is a bit surprising, is sort of this premia for cash flow variability. And what I mean by that is embedded options in a lot of these securities. That wasn't all that common in our industry historically. It used to tend to be pretty vanilla structures, prepayment with make-whole provisions. That's not necessarily the case anymore. We're seeing, public hybrid securities come over with 30-year non-call 5, 30-year non-call 10 provisions, which allow for extendability past 5 years. That's not the expectation from investors when they underwrite it, but the issuer is paying them for that option and they could exercise it. It's the same thing with a lot of securitization offerings now that have an anticipated repayment date, usually around 5 years, but the legal final maturity would be 30 years. And so, yes, they have to pay incremental interest if they were to supersede that anticipated repayment date. But again, it's their option. And so I think that's something that investors should kind of have top of mind as they get into some of these newer sectors and really make sure that they understand the flexibility that's been built in for issuers' favor, but they're being compensated for.
Yeah, absolutely. So there's clearly lots of different drivers for that. So I just wanted to close on 2026 originations.
Sure.
Where do you see the biggest opportunities?
So you're not going to like my response. I'm going to keep it very broad. I think this past year, 2025, roughly by the numbers, talking to different folks here, I think volumes are going to touch 200 billion, which is wild. And so we're seeing year over year growth. If that's the case, just close to our numbers of about 25%. The mix of new issuers versus old issuers has been roughly 50-50 the last few years, which is great. That's the sign of a healthy market. There's a lot of interest in issuers coming to our market, right, and doing debut deals. I mean, 20 years ago, I think it was 80-20 old versus new. So it was just a lot of recurring issuers coming to market more often than not. Across those three sectors, I'll touch on each one. And so alternatives, clearly it's the fastest growing sector in private placements right now. What we really like in terms of the opportunity set is really more your ABL, ABF type financings where you have hard collateral and a really, really buttoned up structure. So esoteric ABS, as I mentioned, is a key one. Credit tenant leases is another one that comes to mind. Equipment or aviation finance with conservative LTVs is, I think, another pocket for us. And there's some interesting fund finance opportunities as well with the right structure, I think. But that's one that we expect, again, to really present a lot of unique opportunities. There's some new sectors we're working on there too and building investment theses around. So we'll see how it plays out, but should be pretty robust in the near term. The next would be infrastructure. So that's a sector that's had some ebbs and flows, let's call it, for the last few years. But this past year in particular, very, very strong. Again, I think that's because of all the financing needs from the data center sector specifically. There's just a lot of secular tailwinds, though. Obviously, Biden's infrastructure bill helped quite a bit, but grid modernization comes to mind. There's going to be quite a bit of spending there. Waste and water, we've seen some really interesting P3 opportunities as of late. Obviously, I mentioned data centers as well. And renewables continues to be quite heavy. And so I think at least in the near term, let's call it next 12 to 18 months, the opportunity set looks very robust. Thereafter, it'll be tough because that's a market where issuers can be a bit fickle and go to the banks quite quickly to get cheaper financing. But clearly they feel like it's a good opportunity to come to us and term out some of that debt. And so that should be solid. And then lastly, most near and dear to my heart, corporates, as I head up corporates in the U.S. for the L&G team. I think it continues to be sort of steady Eddie from an issuance perspective. We've seen some issuers come back that we haven't seen for 10 years, 15 years that are sort of revisiting us. They have new needs, growth CapEx plans, and that's really exciting. We have some new issuers coming that I would almost deem rising stars from sub-IG land that have been private equity backed. And they've gotten to the point now where it makes sense for their capital structure to acquire an IG rating. And so they've gone out and gotten a big 5 rating, which is quite exciting. And then, some of the defensive credits, especially in the triple B category, it seems like their financing needs have come up, but we're comfortable with them. I mean, it's strong free cash flow profiles. They have lots of pricing power. And so I think generally speaking for corporates, if you're okay with some dispersion, and you could really, pick your spots, there's definitely some great opportunities to be had. I don't think the growth will be as robust as infrastructure and alternatives this year, but it'll be a lot of the, repeat borrowers, some new ones. And we're quite excited, I think, for the totality of the opportunity set across all three sectors.
Yeah, and I think your excitement is probably mirrored by the industry. Everybody's expecting 2026 to be a really big year, but it's interesting that beyond that, it might not be the situation.
We'll see.
We'll see.
We'll see.
Thank you so much for joining me today, Andrew.
Thanks, Lily. Appreciate it.